So, yesterday at the lecture I was talking about short-term funding and operating cycle. So, how long does it take to uh, manufacture the product, and then how long does it take to collect the cash after selling this one? And luckily, with our case study, we can model operational cycle relatively easily because we don't have much transactions. I mean, we have, this amount of transactions in a year, but at least not in thousands or millions. So we just have to model this thing. So this is short-term funding and cash flow. Planning. So we need our what? Cash flow plan. And in this case, it will be hard to make this in a proper way. So first, let's say that, okay, we need months. I don't want to go into higher frequency. Monthly data is enough. Then we need, sooner or later we have revenues, but first let's start with expenditures. So right now they are not expenditure, they are costs. So there will be many. So obviously we have to pay wages. That is quite obvious and necessary. And also we have years, so we are modeling in that dimension. So here's first year. Should I do this way? Hopefully Excel will cooperate with us. What on earth? Okay. It was cooperating, just I have no idea. How? Okay, so now we have all the months and years ahead. Then we have the wages, and the wages we have the data from the profit and loss statement and here. And also we know that this is annual wage cost, so we have to divide it, but also we have other factors here because we are adjusting wages by inflation and nothing more. So we have to divide it by 12, and also we have to fix it with the dollar mark. So wages are simple because we just have to do with them. But obviously the second year, now it's not C, it's D. But doesn't matter because the numbers are so small. Then instead of D, now it's A. F. G. Is this in the G column? Yes, the fifth year in the G column, so okay, wages are done. Then, what kind of other wages do we have? We don't care about depreciation because right now we are focusing only on cash flow movement. So wages are out. Then, obviously, the major costs will be coming from manufacturing. So, and in this case, this will be related also to the number of sold products. And this is where we have not much idea about the production cycle. So first, let's create the program for defining the number of first stages to manufacture, and then there will be a number of second stages to manufacture. So in the first year, we know that we have these numbers here. So at the end of the year, we have to provide 3 first stages and 4 second stages. So hopefully we can recover 1 first stage already, based on the probabilities of launching and success and so on. Then in the second year we need 10, we need 20, and after that we just have to create a schedule for everything. And in the third year, finally, we are starting to achieve some reliability in terms of recollection, so we don't have to manufacture as much first stages as before. We are reaching the heaven of economics of scale, and I have to also link this one. Now it's cross-linked with each other, so we know that, okay, at the end of the year, this is how many stuff should be manufactured. Because also at the same time, we have the following launch numbers, so we have to achieve these launch numbers. And we have to achieve this also in a careful manner, so we don't have to launch everything. We don't want to do everything in December, because that would be quite crazy that we are manufacturing during the whole year and then launching stuff. So time. So maybe hello. So first stage manufacturing and then second stage manufacturing. So how many time do we need to make this one? Let's ask Google. Wow. On average. Okay, so they are saying that on their scale it's 1.3 weeks per core stage. Let's ask the other AI overlord. Obviously at the beginning it will take 1 per month And after that, we can cut it down one. So once we are ramping it up, so let's say that in the first year, still we need 3 launches, 3 manufacturing periods, so 1 in the 4th month, 1 in the 8th month, and 1 will be manufactured in December, and it will be launched after that. And for second stages, so second stage only requires 1 engine, requires smaller tanks, so at the end of the day it doesn't require much. Sorry, not one. Yeah. It doesn't require much manual labor. So right now, in the first year, we are just learning. So again, these numbers here are coming from these numbers there. So this is first stage. You are also first stage. Just in this case, we can see the scheduling of the numbers, and then we can see that after that we just have to multiply it with the unit cost, and then we can schedule the expenditures. How many months are we facing this one? Then we have to do the same thing. Now we have to speed these things up. Okay, so let's be less optimistic. So let's say that okay, still we need 3 months for manufacturing. Just now we are manufacturing more of them. Two, 3. So again, we are just ramping up the production. So in the first quarter, 2. First stages we will build, then again 2, then after that 3. So now we became more reliable. And again, in this case, it means that in December still we have to do at least 3 launches. And also at the same time, we are... Maybe I should use different color for that one, so you will be yellow. Then, again, for the second stage, we need 4 times, so at least this can be divided. So 5, 5, 5, 5 should be manufactured, and after that it gives us the 20. And then it doesn't matter, because now the demand for the first stage will decline dramatically. So maybe we can say that okay, let's produce everything in the first part of the year. Now we were able to increase the manufacturing to 3. We don't want to scale up anymore because we need production capacities for the second stages. And then that's a big jump, so let's say 10, then 12, 12, okay, so this can be reasonable for manufacturing the second stages. Again, this is the whole number for the whole year. And in the second half of the year, we don't need manufacturing. First stages or, yeah, so. Then, fourth year. Still we are at full speed, so let's copy this one. Just okay. Due to we have two. We don't have to manufacture two second stages, so that one is where we can get some savings, and we can still manufacturing slowly. And after that, in the last year, we slowly forget how to manufacture second or first stages, because now we just 2 and 2, but still the this. So this is the request from the numbers. So number of stages. Then after that we know that okay, what are the costs, because from the product data sheet we know that everything which is related to the first stage will be located here, and everything which is related to the second stage, it will be added here. So we don't have to care about fueling costs and stuff like this. All the recoverable costs will be just accounted with the second stage. So costs again. Let's put this thing down. Costs will go up. Coloring will be removed. Then first stage cost, second stage cost. So you should go down. So these were numbers, and these are the costs now linked to it. So first stage cost, product, this one multiplied by okay, I'm in the wrong row, sorry. So U. And since these costs are fixed, so we don't have to care about this anymore. So let's connect it to here. Again, this one is multiplied by the product recoverable costs. Let's fix them here. And after that, we just have to scroll down, because if it doesn't find any data, then it will be just 0. Now we can think about that maybe. So obviously this costs. So to reach this point, that where we can see that this is operational, so we have to give this vehicle should be ready at that point. So obviously costs will raise before this time period. So still we have to schedule the appearance of these expenditures in a smoother way. If we would like to struggle a lot. And they would like to, because so this will be the gradual Because now we can see that, okay, this divided by three this divided by 2 after that how can we make this nicer? I mean, we can do it manually, just I hate manual labor. This seems to be quite labor intense. And this is only for the first year. Luckily in the second year it will be way easier because now we don't have this mismatch between the scheduling. So hopefully I can start copy and paste and then don't have to care about the structure anymore. You are happily manufactured, you are happily manufactured. Also you are. Then you are not manufactured, you are also not manufactured. So we have these production cycles for at the beginning for 3 months, then within 2 months we are able to meet also with the quota, with the demand, and this is how costs are rising. So now we get the costs and practically have two kind of costs, so people and manufacturing. So now we just have to schedule in the revenues. Let's put it separately because there will be other issues later on. So euro revenues, euro based revenues. Okay, so we can launch okay, so let's be conservative. So once we are manufacturing the first rocket, maybe we don't want to launch immediately. Let's give at least 1 month for the crew to prepare. Still, it will be dicey in December, but okay, so this is the yellow part, and we have already. Okay, so 2 launches will happening here because otherwise we don't get the 4. Then again we just have to schedule, we just have to look for the yellow numbers after that. So in the second year we don't have such problems anymore because we're just saying that, okay, whenever we manufacture, then we go for lunch. So this one is 5. This one is also 5. This one is also 5. This one is also 5. And then, as a result, at the end of the year, we got the 20. So and now we can just copy and paste again, because the scheduling is the same. So I want it to be conservative only in the first year, and after that they will get used to the schedule. And then we can say that, okay, now euro revenues. If we are following this, then this number multiplied by the price in euros. And then scrolling down, yep, especially that we have to highlight it or fix it with the dollar mark. Then if you are scrolling down, then we can have also the revenues in euros. And now we can start to make liquidity balances. So cash flow balance. At the first glance, what we can see here, that if we would like to try to balance out, obviously here we have zeros, and we have non-zeros otherwise. So revenues minus wages minus first stage costs in manufacturing, then second stage costs in manufacturing, and also fueling costs. By scrolling down, now we can see that what is the case. So this is our cash flow balance during the whole time period. Or we can say cash flow imbalance, because and obviously this one is not in potatoes, this is in million euros. Right now I don't care about the Amazon business, let's focus at first on euro, and then we can play with this one. Maybe it's not a line diagram, maybe bar diagram can be better for this. So we can see that, yeah, we have this short burst of revenues, and after that this short burst will be bigger and bigger bursts, but still otherwise we have expenditures. So now the question is that what is the cost if we have to finance everything from short-term loans, or do we have to do any of this? So first of all, we can say that yes, cash flow balance, but come on guys, we have also a balance sheet, so we are not just existing in thin air. And since I was conservative, afraid, it depends on the perspective, we can see that I was able to collect this nice 900 and lots of millions of euros as a financial runway. So can we say that we can run out of this or not? So this is the initial. Oh, this is end of the year. So we have to be careful what we are adding here. So this is collected at the beginning. So this is there. Depreciation is not there. C21, that one is depreciation. C35, that's the end of the year. We don't have to care about that one as well. I17, that's the financial runway. Okay, so that was cash flow balance. Then this is cash reserve. So this is the bank account, what we have. So let's say that we have the initial. Initial reserve is my financial runway, plus we had this 2.4 million euros in the bank account from the original case study. So this is what Arianespace actually had when the case study was created. And then we can say that, oh, this money plus this money here. And then we should see some changes. Hopefully it should not run to 0. Did I delete my beautiful... Oh, I deleted my beautiful graph. Then let's bring them back. So it's now goes up. And also we have... still we have to calculate with the interest expenditures and also interest revenues. So this is not perfectly fine. But at least what we can see here that this yellow line or orange line, which represents the life for the company, is still remains in positive. This is absolutely positive. So it's good. Then still we need additional costs. So financial, so interest, altogether financial costs. Financial expenditures, so all the paid interests and so on. At the end of the year, we just have to announce this, that okay, this is... Let's use a different gray for that one, because this happens only once in a year. So from the profit and loss statement, we know that paid interest plus hedge expenditures plus paid financial lease. I'm adding everything because I know that they are 0. They are located here. Then the same stuff should be repeated. Maybe it's faster if I'm... plus for the third year, plus again, for the fourth year, again expenditures, as I was not creating debt for my scenario, this doesn't matter so much, but if we would be highly indebted, then obviously this would be more relevant. Then revenues. Now this is the tricky part. So since I'm using up all cash reserves from month to month, I cannot say that, oh, let's throw everything into term deposit, because we cannot break the term deposit, otherwise we are losing the interest. So we are forced to have monthly interest. And Easter rate So the euro short-term rate is 1 point. So it's changing. So this is an overnight interest rate. But this is annualized interest rate. So we can see that this is 1.9. It would be really hard to make, not that hard to make projections, because we just have to estimate a Taylor rule and just make forecast about the Taylor rule for 5 years ahead, and then we can have a programmed interest rate expectations. But maybe we don't want to do this today. So let's say that okay, the short-term monthly interest rate is 1%. So this is for banks, so the euro short-term rate is for banking system. If they are giving half of it to us, then this one is already enough. So even if it increases, decreases, it's still robust against changes. So we can say that so this will be interest revenue so this money was unused, and then again we have to fix it, otherwise it doesn't work. So obviously if we are working at the treasury, we are trying to push this 1% at a higher level. We are trying to sophisticate it. Right now we are not working at the treasury, so we are only paid to do only this one number. So we have an interest revenue. It would be much better if it would be relocated here, because this is where all the other revenues are located. So now we can see that there are two kinds of revenues. One is about operations, one is about financial portfolio, which is just a cash reserve in a bank deposit. And since we have this, here also we have to add this just in this case I'm creating a circular relationship, and Excel will be not happy at all. Because right now this is referring to that one, so it will be just going in full circles. We need some kind of a leg. One leg system to avoid such circularity. So in this case, if we are just adding the revenues this way, okay, we are not biased completely. Or still we can say that, okay, here we are just getting the interest rate on the initial reserve, and then with it. So after that, we could just say that, okay, seemingly we don't need to be so conservative with my financial runway. So at the end of the day, I could just cut it down until... What was the lowest? Maybe 100 would be enough. Yeah, but anyway, this is how I was able to raise or get my equity and get the share in the company. So it doesn't bother me so much. And now we have the cash flow plan in euros. Obviously, if we have to add US dollars to the game, then we have to complicate all this stuff further. Why not? Before I'm messing up everything, then let's create a secondary copy of this one. So this is short-term funding. In euro. And this will be short-term funding. Euro US dollar. So now we just have to add the related expenditures also in euros and US dollars, and then we have to combine them, and then we have exchange rates. So first of all, we don't want to complicate stuff, so which direction or which denomination do we have? Oh, USD euro, okay. And now I have to move it here, otherwise I'm losing it. So it's 1 to 1, and after that we will just modify it. Right now I don't care, I just have to program it. Then for revenues, we have all the same ordeal, but for US dollars. First numbers, then revenues. So this is USD scheduling. Schedule. And this is the USD. And I have to change all of this. No, because I was crazy enough to put all the US dollar revenues only in the last 2 years, at least. So there are 9. It's okay. You have 9 here. Let's use different purple. We are doing it for Amazon. So this now launches will happening. And which means that now we have to reduce the euro revenues in this case. So -9. And then let's do the same thing in the last year as well. So this will not happening because we are delivering to Amazon. 9 launches only within 1 month. That's a bit sketchy. But let's ignore it. We could be way more precise in this, but... And also we know that we like Amazon so much that we are asking for more money per launch. So... What? Okay, so can you copy this one? No, it cannot because it's said. Then can you copy now? What? Oh, come on, you never had this problem before. Yeah, you can copy it. So, finally. Then, let's multiply it with 9. I'll also multiply this number with u. Okay, so now we have the revenues in US dollars. And of course, we have to convert it back to euros. So it's easier just to modify this and not create a euro revenues. Come on. So this will be altered. And that's why it will have another ping. In this case, we can highlight that, okay, it has US dollar content in it. And then we just say that, okay, this is in US dollars. You have to multiply it or divide it. What have we done here? G. Okay, we were dividing it. So plus you divide it by the exchange rate. And then we can be happy. So we don't want to create US dollar reserves yet. So automatically whenever we are just realizing this revenue, then we are converting it back to euros because this is proper currency. And then after that, we are keeping it. Next week, when we will we do the planning for tax optimization, this will be a different story, but right now it's not. And then we have the foreign exchange rates. Let's just use the expected regime for each year. Again, that's to limit the complications altogether. Value transposed, and then just we have to copy it for each year. But I cannot see because we have too many lines here and there. Okay, so okay, so these are the expected exchange rates for each years. Expected rate. So now we just have to say that, okay, this is you. And now what? No. One point 1.16, yes, okay. So that was all the changes in the exchange rate. what we can expect right now. And then it was recalculated, but we can see that there were not much change at all. So since I buffered up a lot of cash reserves, then it's not a great challenge. So after that we can make this short-term plan to be more sophisticated by stretching the schedule, by even improving the schedule, because right now I'm just creating discrete one unit during 3 months, but at least here we have stretched expenditure structure, so at least here we can see that okay, we have to work on this. And after that they have a happy month when they don't have to work on this, but at least in this case I was able to see what is happening. And then we are just selling stuff. So once it's delivered. Yeah, so this would be the beauty of the operating cycle. Cash conversion cycle, it's hard to say anything because we have no data about this. So hopefully once we are launching stuff, then they are paying us immediately. So we don't have to wait for 3 months or 9 months for payments. So that's why I did not create a third scheduling system for, okay, we delivered, but how many times do we have to wait? Actually, we can do it since we have plenty of time for that one. But okay, let's move. Now we can relocate them. So let's improve towards the cash cycle. CC, so this will be not just a cash flow plan, but also now we are collecting the money as well. So we have the scheduled arrival of our friendly euros, but what happens if we have to wait only 1 month? Obviously this will happen, that we have to wait 1 month after delivery. Then push everything downwards. Boing. What happens with the cash flow balance? We have to correct this one, so this is happening here. Then we have to go down. And also we have to do the same thing here, so pushing everything downwards. Does it have a significant impact on our operation? Not because we are stuffed with cash. Okay, so let's highlight this one. Okay, this cash cycle was defined. But let's see what happens if I'm not filling up the whole money with cash, and practically we are part rocket company, part wholesale, or wholesale interbank market player, where we are living sometimes even more from the interest revenue than from rocket launching. So let's create the last one. the many with actual short-term funding. So this is the no financial runway. Yep. So let's test this schedule that what happens without this runway. Okay, let's use red. This is a warning. So what happens if I'm just erasing this cash reserve? How much money should we borrow on short run? So yeah, now it's has been changed. This is the level of cash reserve, so that's why I'm changing it to red. And now we can see that we can go down until the first quarter of the second year for minus 130 million. But after that it jumps back and then it goes up to 200. So after that we don't need such amount of money. So still we can say that from short-term funding point of view, only 100 million euros can be completely enough if we would like to stretch up completely the funding. So if it would be funded from debt, then this amount of money would be enough. If it's funded through equity, then it doesn't matter because we already purchased the shares in the company, so now it's not a problem anymore. But still, let's see that, okay, financial expenditure, so we have a debt. Oh my god, I made one mistake. Short monthly interest rates are 1%. This is not good because in this case it would mean that the annual interest rate would be 12. And this is not nice, so we have to divide it by 12 here. That was suspicious that we are earning so much money from the deposits. Yeah. By 12. And also by 12 here. I'm increasing the number of the digits. So, what happens when we would like to get funding for all this nice stuff through just ordinary short-term revolving debt? So we are just taking up loan more and more from the bank to cover each month minus until we are reaching positive cash flows, and then we start to amortize this debt away. So this will be really simple, relatively. So debt, let's say loan or credit, doesn't matter. So, and also we need also short-term interest for this loan. When SpaceX had revolving bank credit or bank loan, also they had LIBOR plus 4.25% of interest rate. It was a variable interest loan. So let's mimic the same thing. What is LIBOR in but LIBOR should be really close to Ester. So let's say that, okay, it's 2% plus 2.25%. And then let's divide everything with 12. So this is the monthly interest rate on the debt. Did we use... Oh, we didn't use blue color. At least not this part. You use this one. I don't know what is the name of this color, but yeah. Okay, so here, do we have to take up a loan? No, we don't have to take up a loan because this is positive. So right now our debt is 0. Then here we have to take up the loan for that one. Then in the next month, we have to take up this number plus the previous position, but now multiplied by, oh, not even using bracket here, multiply by bracket open 1 plus u. So previous month's debt is now growing with the monthly interest rate plus the current position. And I would like to limit the level of digits here. So yeah. And now we just have to do the same thing. What? Ah, and also I have to fix the interest rate because otherwise this will go haywire. Yes. So we have the first happy month. So finally we were able to launch stuff. Ah, that's the second happy month. Just here we can see the fruits of this one because of so many expenditures. But this is the first happy month here, and now we can see that okay, our debt level decreases a bit. But let's roll forward. So this is the problem that this is when we can start amortizing, but already the debt level is high. So okay, we don't want to do this anymore, so this is where it stops. So this is only happening until we are in losses. Bless you. So from this perspective, taking up or collecting my Giga Fund to provide a financial runway for the company, it's not that far-fetched. Because otherwise we would start to raise up our debt level so much in the first 1.5 year, which would otherwise hidden or it would remain hidden if we are not doing this debt-based scenario. And of course, since we have to do this, we have to also add to the financial expenditure this number here. Yeah, not complicated at all. So, okay, here is 0 because we did not have to pay anything, but now this number multiplied by this number. Again with the limited no, then I will do it manually. What? I fixed both of them. Good. not good. This should not be fixed. Okay, so now it's increasing happily. Then we have this guy here. Plus. Okay, so this is the hiccup part. Yeah, this is still moving forward. And now it's dead. Okay. So now financial expenditures from more debt are built in, and the cash balance is not affected much because it's quite marginal, but at least now we can see that how cash flow balance will be reacting on everything here. So at the end of the day, what was interesting for us is to see that how the cash balance will react. Again, this is not a line, this should be a bar diagram. Also, let's add the dates. What? I updated the wrong one. Yes. And here we can see also we could add cost revenues, but it would just make things complicated. But let's add also the debt. And the structure. Euros. So where is the? Yeah, not here. Yeah. How come it should be downwards, not sideways? And so now we are the happy owner of our cash flow plan and cash flow scheduling, because now we can see that how cash flow balance is changing from month to month. Now we can see if we would fund completely through short-term debt, then it would be really expensive, so maybe we should not do it. And at the end of the day, we can see that how the company its position changes from month to month. Also, we can add one more thing, so cash reserve. It's always nice to see cash reserve. So this is your name, and these are the values. Yeah, this is what I was looking for. So for the cash reserve, it's much better to add the line, because and maybe move it in the secondary. axis. Yes. It would be so nice if the 0 would be at the same place. Oh, no, okay. Again, this is as well as the same. Million euro scale. So now we can see that, okay, how the bank the cash reserve is affected and everything is affected by our operations. So this is the cherry on the top of the cake. Okay, so that was all for today. From this one, I don't want to ask assignment because that would be boring and technical. Today at lunch, I was even talking about this with my colleagues from the accounting, and they were saying also that this is also finance, and yes, but it's also accounting. So yeah, that's the hot potato.